Okay, we'll see now segment 5, value of supply. Have a look into this in page number 51. Segment 5, value of supply, page number 51. Section 15 is the only section that we have in this segment. Plus, we have certain rules also, starting from rule 27 to rule 35. So, these are the various rules and only one section, that is section 15. Section 15, subsection 1 says that assessable value means value on which GST is assessed is known as assessable value. That assessable value will be taken as the transaction value if the following conditions are satisfied. What are the two conditions? Price must be the sole consideration, supplier and recipient are not related. If supplier and recipient are related, then assessable value is not equal to transaction value and we need to determine the value as per rules. Same way, if price is not the sole consideration, then also we will not take transaction value. What is this transaction value basically? Transaction value is nothing but the price involved in the transaction, that is price actually paid or payable. Price actually paid or payable will be known as transaction value. So, assessable value equals to transaction value if two conditions are satisfied. What are the two conditions? Price must be the sole consideration, supplier and recipient are not related, and then transaction value will be taken as the value for payment of GST. What is transaction value? Nothing but the price involved in the transaction, which is price actually paid or payable. Now, whenever there is a supplier who is making supply of goods or services or both to the recipient will pay some amount. So, that payment only will be taken as the transaction value. To this transaction value, we need to make certain inclusions. So, total 5 inclusions we need to make. As per section 15 subsection 2 clause A, any tax, duties or cess by whatever name called other than GST should be included in the value. So, what does it mean? For example, whenever we are importing goods, we are required to pay customs duty. Also, we are required to pay IGST. So, for computing IGST, first include customs duty and then you take the IGST. Same way, on movie tickets, there will be entertainment tax levied by local authority and there will be GST. While computing the GST, we need to first add the entertainment tax and then we need to add the GST, which means GST will be the last tax in the computation. So, when you do the computation of GST, all other taxes, duties by whatever name called should be included, and in the line, the bottom line will be GST component. Then 15(2)(b) says that if recipient is incurring some expenditure on behalf of the supplier, that expenditure should be included in the value. Say for example, for outstation audit engagement, it is the liability of the supplier as per audit engagement to incur the transportation expenditure, accommodation expenditure, etc. But the client has incurred that expenditure. So, therefore, client incurring the audit expenses, that is client incurring the travel and accommodation expenses on behalf of the chartered accountant will be included in the value of the chartered accountant as per 15(2)(b). So, that is recipient incurs the expenditure on behalf of the supplier, such expenditure shall be included in the value. What if the client is incurring the expenditure on his own account? Means as per audit engagement, it is a liability of the client only to incur the travel expenditure and accommodation expenditure, and he incurred. Will it be included in the value? No. So, if recipient is incurring expenditure on his own account, such expenditure shall be excluded from the value and it will not be included. Then 15(2)(c) says that supplier is incurring some expenses and recovering it from the recipient in the course of supply, such expenditure it should be included in the value. For example, say I will be providing some services to my client, some audit services to my client, and for these services I may incur some expenses, and these expenses I will recover from my client as out of pocket expenses. This will be included, that is article students and all will be staying in one hotel. From hotel to the place where audit takes place, they need to travel by auto, and in case when they travel by auto, so they will be signing the voucher. If it is 50 rupees and all, 150 rupees, 250 rupees, they will sign the voucher. So we cannot produce the actual bills and all for this. So therefore we will collect it from the client. So this is known as expenditure incurred by the supplier and recovered from the recipient in the course of supply. Such expenditure should be included in the value. Now here one important point is that the expenditure may be exempted, but the moment that expenditure is recovered, so the character of the expenditure will change and it will be included in the value of our service. So means that expenditure may be exempted. Example, there is a apartment owners association, so that will be paying the electricity charges and electricity is exempted, but when they recover that electricity charges from the members as maintenance charges, the name of that electricity charge is now converted to maintenance charges and it will become taxable. Same way, toll charges are basically exempted. So whenever the toll charges are paid by the driver, he will not pay any GST on toll charges because toll charges are exempted. But the same toll charges, when he recovers along with his fare for transportation, the toll charges will be included in the value and the toll charges also will be chargeable to GST. So all reimbursable expenditures, when we incur and receive from our customer or recipient, the character of that reimbursable expenditure will be changed to the character of our service. So consequently, it will become taxable. Okay. Then next, however, we have a relaxation here. Whenever that expenditure is incurred by supplier on behalf of the recipient as a pure agent, that expenditure shall be excluded from the value. Say for example, chartered accountant is paying the income tax on behalf of the client, will not be included in the value because that income tax is the liability of the client which is incurred by the chartered accountant and in turn recovered from the client. So that will not be called as expenditure incurred in the course of supply, but it will come under expenditure incurred as a pure agent and it will be excluded. So when such expenditure will be called as expenditure incurred as a pure agent is given in rule 33 that you can see in the next page. Total 4 conditions should be satisfied in order to be called as pure agent expenditure. First, the supplier should enter into agreement with the recipient to act as a pure agent. In this example, the chartered accountant should agree with the client that chartered accountant will incur the income tax liability on behalf of the client. There should be a written agreement related to this. Second, supplier should recover only the actual amount incurred. So chartered accountant will pay say some 5,500 as income tax. That 5,500 only should be recovered from the client. He should not recover anything more than that. Supplier should not hold the title to the goods or services so procured. So that income tax paid receipt should not be in the name of the chartered accountant. That should be in the name of the client. And supplier should not use the said goods or service so procured for his personal purposes. So the chartered accountant's income tax, if it is paid and in turn recovered from the client, that will not be coming under a pure agent. So what are the 4 conditions? First, there should be an agreement. Number 2, only the actual amount incurred should be recovered and it should be, the title should not be in the name of the supplier. And number 4, so it should be so procured, it should not be used for the personal purpose of the supplier. Now let's see one example, the toll charges example. Actually, toll charges which are paid by the Ola, Uber and recovered from the passenger, so will it come under expenditure incurred as a pure agent? First of all, who should pay the toll charges? Whomsoever is using that road, they need to pay the toll charges. And so as per written agreement, whether the supplier will undertake to pay the toll charges on behalf of the recipient? Yes. Usually when you book the Ola or Uber, you will accept all the terms and conditions. In that, one of the condition is that Ola or Uber will pay the toll charges on behalf of you and along with the fare, they will be recovering it from you. So there will be a written agreement. Number 2, only the actual amount incurred should be recovered. Yes, they will recover only the actual amount incurred because they will show separately this much is the fare plus toll charges. Clearly they will be showing how much is the toll charges. So only the actual amount incurred will be recovered. Number 3, should not hold the title. The supplier should not hold the title. Unfortunately, this condition is not satisfied because the toll receipt is not in the name of the passenger. The toll receipt is in the name of the driver, in the vehicle owner's name. So due to that reason, the title is not in the name of the recipient, but the title is in the name of the supplier. So pure agent condition not satisfied. Due to that reason, the toll charges should be included in the value or excluded from the value? Included in the value. So all these 4 conditions should be satisfied. If any one condition not satisfied, it will not become pure agent. consequently that expenditure will be included. So what are the 4 conditions? Supplier should enter into an agreement with the recipient to act as pure agent, only the actual amount incurred should be recovered, and supplier should not hold the title to the goods or services so procured, and supplier should not use it for the personal purpose of the supplier. Then if it becomes pure agent, it will be excluded from supply, otherwise it will be included in the value. Okay, then next we have 15(2)(d). 15(2)(d) refers to interest, late fee or penalty for delay in receipt of consideration. Say I gave an invoice to you and I have given you 30 days credit period. You did not pay within the 30 days. So I will have a right to recover interest or late fee from you. So that interest or late fee or penalty will be included in the value and chargeable to GST. So this interest, late fee for delayed payment shall be included in the value as per 15(2)(d), and this interest will be taxable on receipt basis, not on accrual basis. In GST, everything will be taxable on accrual basis, but only one place it will be taxable on receipt basis, that is this interest, late fee or penalty for delay in receipt of consideration. So which means I have right to recover the interest from you and I asked you to pay the interest, you have not yet paid. Should I include it in the value and pay GST? No. Only when you actually pay to me, I need to give you one document called as debit note. So whenever this interest is collected from the recipient, the supplier will be issuing to the recipient one document called as debit note, and when the debit note should be given, not at the time when interest is due, but at the time when the interest is received. And this interest will not be taxed as a standalone transaction. This interest will be included in the value of original supply. Suppose if the original supply, that is the invoice, is taxable at 12%, this interest also taxable at 12%. If the invoice is taxable at 18%, this interest is because of non-payment of that invoice only, na? So therefore, if invoice is taxable at 18%, then this interest also will be taxable at 18%. If the invoice is exempted for non-payment of that invoice, if interest is levied, that interest is also exempted. Got it? So therefore, this interest is not a standalone transaction. It derives the tax rate from the principal supply. What is the principal supply here? Invoice. For non-payment of that invoice, this interest is collected. What if in that invoice there are 2 rates? So product A, product B, 12%, 18%. Now what we need to do? Bifurcate the interest on account of delay in receipt of consideration between product A and product B in its invoice value ratio, so that you will know as to how much should be taken. Say for example, say invoice, in an invoice there are 2 products, product A and product B, and product A is 1 lakh, product B is 50,000, and GST rate is 18% for product A, 12% for product B. So 1,18,000 is the total amount due for product A and 56,000 is the total amount due for product B. So the total amount will come to 1 lakh. So 74,000. 1,74,000. This 1,74,000 is not paid. As 1,74,000 is not paid, so interest on account of delay in receipt of consideration, interest on delay in receipt of consideration, how much is that interest? Say for example that interest is 12,000. Now this 12,000 is chargeable to GST, but this 12,000 is chargeable to GST at what rate? 18% or 12%. We need to bifurcate the 12,000 between product A and product B in what ratio? In 118:56 ratio. Okay, so interest with respect to product A, interest with respect to product A is 12,000 into 118 divided by 174, and you will get some amount. Same way, interest with respect to product B, interest with respect to product B will be 12,000 into 56 divided by 174. So we get the interest, and on this interest we need to compute the GST, and whether we are going to receive anything extra beyond this 12,000, no. So in the absence of information, this 12,000 should be assumed to be inclusive of GST. Generally all expenses are assumed to be exclusive of GST, but this interest should be assumed as inclusive of GST. So therefore, what is the interest component here? 12,000 into 118 by 174, 8,000. 8,138. Now GST on above. How much will be the GST on above? This 8,138 is pertaining to product A. Product A is taxable at what rate? 18%. So therefore this interest also will be taxable at 18% into 18 by 118. Then GST on above, that is product B. Product B is taxable at what rate? So 12%. So what is the interest with respect to product B? The balancing figure, that is 3,367. How 3,367? 3862. So in Kochi there is one airport. Keep your calculator below the flight. It will work properly. If this also you are not able to do, I don't know. Okay. So 3,862 into 12 divided by 112. So how much it comes to? 1,243. And this one 8,138 into 18 by 118. That only 1,243. Here you have calculator here. You have to just press 8138 and one into symbol will be there. You press that and 18 divided by will be there. Press that 118. One number will come. Tell me that number. 1241 and this one 3862 into 12 by 112. 414. So in calculator one number will come. In that also you have a confusion. So GST and above will be 414. So this is how we need to compute the GST with respect to product A and product B. Then so interest, late fee for delay in receipt of consideration should be included in value, and it will be taxable at what rate? At the rate applicable to the principal supply, means whatever is the invoice rate, and it will be taxable on what basis? Receipt basis, and it will be taxable usually on inclusive of GST if GST not shown separately in the invoice. Then we have 15(2)(e). What is that 15(2)(e)? Subsidy. Subsidy divided into two, directly linked to price, not directly linked to the price. If the subsidy is directly linked to the price, how do we know that it is directly into the price? Means subsidy is based on outward supply. For every product sold or every service rendered, there will be some amount given as subsidy. So subsidy directly linked to the price, that is subsidy based on outward supply. If it is from CGRSG, it should be excluded from value. If it is from others, it should be included in the value. Okay. And if it is not directly linked to the price, means subsidy is received irrespective of the outward supply general amount. So then it should be ignored and not considered in the value. For example, if I am getting subsidy for every product sold or every service rendered, so I gave an example of MRF Limited, which will be giving subsidy to the car manufacturer for each tire used in the car manufactured by them, then it is directly linked to price. Suppose whether they are using it or not, some amount is given as subsidy, then it will be coming under not directly linked to price. So therefore, whenever the subsidy is given per unit or per service like that in question, definitely it is directly into the price. Suppose some lump sum amount is given in the question, then it is not directly into the price. When the subsidy is not directly into the price, ignore it and don't consider it for valuation, and you treat it as donations. Donations already we know, conditional donation, unconditional donation, that treatment we will apply. Suppose if the subsidy is directly linked to the price, check is it from central government or state government or from others. If it is from CGRSG, it is to be excluded from value. If it is from others, to be included in the value. Then if the question is silent, consider the given price as after reducing the subsidy amount given in the question. So what is this? This subsidy, usually it will be pretty much confusing in the exam. So we have to take two assumptions. Okay. Say for example, the price involved is 12,000. Price involved is 12,000. Subsidy from central government is 3,000 and subsidy from NGO is 2,000. So this is how the question is given. Now the question is silent. We don't have any information beyond this. We know that the price given in the question is 12,000 and the subsidy from central government is 3,000, subsidy from NGO is 2,000. There are two treatments that are possible. So we can either take the assumption that the price is after considering the subsidy or the price is without considering the subsidy. Suppose if you take view 1, price after considering subsidy, that is view 1, price after considering subsidy. What does it mean? Price after considering subsidy means this 12,000 rupees we arrived after reducing 3,000 and 2,000, means there is some X as the original price. From that X we reduced 3,000 and 2,000, that is 5,000, and we got 12,000 rupees. This is view 1. Okay. Whereas view 2 is that, so price without considering subsidy, price without considering subsidy. When we take price without considering subsidy, means that X itself is 12,000, means this 5,000 is not yet reduced. This 5,000 is not yet reduced. The 12,000 itself is before reducing this 5,000 rupees. Now in this case, how the valuation will differ? Now we will take transaction value. So what is the transaction value here? 12,000. 12,000 and subsidy from central government, subsidy from CG to be included or to be excluded? Generally as per provisions. So subsidy from central government is to be excluded from the value, because subsidy from central government or state government to be excluded from the value, from others to be included in the value. So subsidy from central government is to be excluded from value, but in this price it is already excluded, because how we arrived at 12,000 after reducing this 5,000, so already reduced, so ignore. Then subsidy from NGO, subsidy from NGO, so it is to be included or to be excluded? Is it from CGSD or others? Others, to be included in the value, but in the given price it is deducted, so therefore we need to add. How much is that? 2,000. So the value will be taken as 14,000. Whereas view 2, transaction value will be taken as 12,000. And subsidy from central government, subsidy from central government to be included or to be excluded? To be excluded. And in the given price it is not yet excluded. Not yet excluded. Why? Because the 12,000 is before deducting subsidy. So we need to reduce. How much is that? 3,000. And subsidy from NGO, subsidy from NGO to be included or to be excluded? To be included. And in the given price it is already included. We have not yet deducted, so therefore ignore. Then the value will be taken as, so 9,000. But sir, we get two different answers. Yes, that's what, two different assumptions when we take, we get two different answers. But which assumption we need to take for exam when the question is silent? When the question is silent, we need to follow this view 1 only if question is silent. If question is silent, we need to follow view 1 for the exam purpose, because CA Institute also in many cases they follow view 1 only. That is, they assume that the given price is after considering the subsidy, which means in the given price the subsidy given in the question is already reduced and they have arrived. Suppose if the question clearly says the price is without considering subsidy or after considering subsidy, you follow that only. Only when the question is silent, then you need to by default follow view 1. So that's what I have given here. That is, if the question is silent, consider the given price as after reducing the subsidy amount given in the question, that is original price minus subsidy is the given price. So these are the 5 inclusions that we have. What are the 5 inclusions? 15(2)(a), taxes, duties and cess by whatever name called other than GST. 15(2)(b), any expenditure incurred by the recipient on behalf of the supplier should be included in the value. Then 15(2)(c), any expenditure incurred by the supplier and recovered from the recipient. Then 15(2)(d), interest, late fee for delay in receipt of consideration. Then 15(2)(e), subsidy received by supplier. Okay, these are the 5 inclusions that we have, and in that some special points also we had that we have seen. Then next, Look into this circular, next page. Passenger service fee and user development fee collected by airline operators from passengers. Usually what happens, airlines will be providing like services by way of transportation of passengers, and they will be collecting the ticket amount. Apart from the ticket amount, airlines will also collect UDF and PSF. UDF refers to user development fee, PSF refers to passenger service fee, and they will collect it and remit it to the airport operator, because this user development fee and passenger service fee is not a consideration to the airlines, but it is a consideration to the airport, as airport will be providing lot of facilities to the passengers like washroom facilities, water facilities, internet facility, so for which they will be collecting this user development fee or passenger service fee. But directly airport will not collect it from the passenger, so they will collect it from the airlines. So first the airlines will collect it from the passenger, and thereafter they will remit it to the airport. So therefore airlines is acting as a pure agent. How airlines is acting as a pure agent? Actually this UDF and PSF is whose liability? Passenger liability. But who is paying? Airlines is paying, and in turn recovered it from the passenger. So therefore they are acting as a pure agent, and that should not be included in their value, which means airline is required to pay GST on what? Only the ticket amount that they are collecting from the passenger. So passenger service fee and user development fee collected by airline operators from passengers are to be remitted to airport operators and falls under expenditure incurred as pure agent. So we have seen 15 subsection 1 inclusions and 15 subsection 2 exclusions. 15 subsection 1 meaning, 15 subsection 2 inclusions, and 15 subsection 3 exclusions from the value of supply. So what are to be excluded from value of supply? Only one, that is discount. So discount is to be excluded, but the discount is divided into broadly two: discount given before or at the time of supply, discount given after supply. Discount given after supply again divided into two. Discount is given after supply, but the terms are agreed before at the time of supply, or the terms are not agreed before at the time of supply. Example, trade discount. Trade discount is given at the time of supply itself, whereas cash discount is not given at the time of supply, but it will be agreed between the parties that if the recipient makes payment within this time, so then the supplier will give a cash discount. So the discount is given before supply or after supply? After supply. But whether the terms are agreed before at the time of supply? Yes. Whereas end of season sale discount, so supplier will give this discount when the stock is not at all moving in the recipient's place. So therefore this discount is not given before or at the time of supply, it is given after supply. But will it be agreed before at the time of supply? No, it will be given only after supply, not agreed before at the time of supply. If it is agreed before at the time of supply, definitely no one will buy. Will I sell the product to you telling that, see, this product I am selling to you, it will not be sold. When it is not sold, I will give you a discount. So no idiot will tell that. Depending upon the saleability only it will be known. So due to that reason, the terms are not agreed before at the time of supply. Now, if the discount is given before or at the time of supply, it is allowed as a deduction. But if the discount is given after supply, but the terms are agreed before at the time of supply, then also it is allowed as deduction. But how to deduct it? Invoice already prepared. For that, we will be giving one document to the recipient called as credit note. Supplier will be giving one document to the recipient called as credit note. In that credit note, supplier will mention how much is the discount that he is offering. Because of that credit note, what will happen to the liability of the supplier? The liability of the supplier will be reduced. Okay. For example, say this, generally there is a supplier who is invoicing it to the recipient. Say invoice value is 1 lakh plus GST at 12%. What is the journal entry for this? In the books of supplier, and in the books of recipient, what is the journal entry for this transaction? In the books of supplier, it will be, so sale transaction it is, so recipient account debit 1,12,000 to sales account 1 lakh, and to GST account, GST payable account 12,000. Whereas what recipient will do? Recipient will mention it as purchases account debit, that is 1 lakh, then ITC account debit. So input tax credit for recipient, whatever GST paid on purchase will be known as input tax credit. So input tax credit account debit 12,000 to supplier account, that is 1,12,000. Now what happens? Supplier is giving a cash discount. So when the cash discount is given at 5%, cash discount 5%, so that is 5% of what? 1,12,000. So how much it will come to? 5,000 plus 12% of 5,000, 600 rupees will be the cash discount. So 5,600. Now 5,600 only, na? Yes. So now what is the journal entry for this in the books of supplier and in the books of recipient? What will be taken in the books of supplier and in the books of recipient? So in the books of supplier it will be cash discount here. Cash discount. Discount is lost to him. Correct? Discount allowed account to recipient account. Recipient account will be credited for 5,600. Discount allowed account debit is 5,000. And what is this numerator? GST. GST payable account debit 600 means what happens because of cash discount? GST liability shows a credit balance, means it's a liability, and the moment they give a discount, so automatically the liability is coming into debit, means there is a reduction in liability. How this reduction in liability will happen? By issuance of a credit note for this transaction. Okay. Now, so therefore because of credit note, what happens to the supplier's liability? It will be reduced. And what will happen to the recipient? See the recipient entry. So discount receipt. So supplier account debit. Supplier's balance will come down now, 5,600 to discount received account. What is the discount received account? 5,000 to GST payable account. What is the GST payable account? 600. Okay. So actually this GST payable, instead of putting it as GST payable, we can put it as ITC account. Why ITC account? Because already he took the input tax credit of 12,000 now. Now that input tax credit will come down. So what is the consequence of credit note to the supplier? Supplier's liability will come down and recipient's ITC balance will come down. You understood or not? So therefore that's what I have given here. So allowed as deduction, a credit note shall be issued. Because of the credit note, recipient should reverse the proportionate ITC. How recipient will reverse the proportionate ITC? Like this. So this ITC will be coming on to this. Usually ITC will show what balance? Debit balance. But to reduce that ITC, they need to credit. That is known as reversal of ITC. So where we will do reversal of ITC? In GSTR 3B. Then next. Suppose if the discount is given after supply and the terms are not agreed before or at the time of supply, so is it allowed as a deduction? No. So it is not allowed as deduction. For example, I sold goods to you for 1 lakh rupees and I gave you 50% discount. So therefore definitely you will not pay me 1 lakh, you will pay me only 50,000, but I need to pay GST on 1 lakh. Why I need to pay GST on 1 lakh? Because end of season sale discount is not allowed as a deduction. Then next we have one issue related to whether GST is applicable on additional or penal interest on the overdue loan. So generally there are two transactions here, hire purchase transaction and hire purchase financing. What is a hire purchase transaction versus hire purchase financing? In hire purchase transaction here, there will be only two parties, hire vendor and hire purchaser. What I will do, I will give you the asset and you will pay me the installments. Okay. This is hire purchase transaction. In each and every installment, there is a principal component and an interest component. Agreed? And that principal component is towards sale of goods, but that interest component is for delay in receipt of consideration, that interest component will be chargeable to GST. Got it? Why? Because this will come under interest on account of delay in receipt of consideration. Whereas in hire purchase financing, there will be three parties. What you see practically in today's scenario is hire purchase financing. What happens? You want to buy a two-wheeler or a four-wheeler. You go to the showroom, you select the car, you select the two-wheeler, and there will be one financier sitting in the showroom, and you will make an application with the financier, and the financier, lot of financiers are there, like Bajaj Finance or IDFC Finance, or even Shriram Finance, like that. Lot of financiers are there. What these financiers will do, will make the payment to the seller, and will recover in installments from the buyer. You got it? Now, in every installment EMI, there will be interest component. That interest will be exempted. Why? Because interest on account of delay in receipt of consideration is taxable, but interest on loans, advances, deposits is exempted. Got it? So write down in your notebook, taxability of interest income. Taxability of interest income. Taxability of interest income. Taxability of interest income. Branch it into two. Taxability of interest income. Branch it into two. First branch is interest on loans or advances or deposits. Interest on loans or advances or deposits. What is the treatment of that interest on loans, advances, deposits? Exempted. So right there it is exempted. Exempted. Then second branch, interest on account of delay in receipt of consideration. Interest on account of delay in receipt of consideration. Interest on account of delay in receipt of consideration. So what is the treatment of this interest on account of delay in receipt of consideration? It will be taxable, but wait. We cannot conclude it as taxable. What is that we need to know? It is included in the value and taxable accordingly. Means if the main transaction is taxable, this interest on account of delay in receipt of consideration also taxable. Correct? So right there, included in the value and taxable accordingly. Included in the value and taxable accordingly. You understood the treatment of this interest? Yes. Now tell me, hire purchase transaction, interest is taxable or exempted? Hire purchase transaction. In hire purchase transaction, how many parties are there? Two parties. And that interest will be called as interest on account of delay in receipt of consideration. So that interest will be included in the value and taxable accordingly. Correct? As the interest in hire purchase is taxable, for non-payment of a EMI, they will be levying a penal interest. That penal interest also taxable. Whereas hire purchase financing interest is exempted. For non-payment of the EMI, they will be levying penal interest. That penal interest is also exempted. If the main interest is taxable, penal interest also taxable. If the main interest is exempted, penal interest is also exempted. That is about this hire purchase transaction and hire purchase financing. Got the clarity? So read it once. So just go through those 2 points. You will get a clarity about whatever I have discussed so far now. Done? Yes? Okay. Then see the next page. Treatment of inclusions or exclusions in the given price to arrive at the value. So first we need to see an amount is to be included or not as per the provision, and in the given price is it already included. If it is yes, then ignore. For example, so we need to include packing charges, correct? Why packing charges to be included? Packing charges is expenditure incurred by the supplier and charged to recipient. So therefore whether we need to include that expenditure or not? Yes. And in the given price it is already included. So again will you add? No. Then an expenditure is to be excluded. In the given price it is already excluded. For example, like GST, taxes, duties and cess by whatever name call other than GST to be included, but GST to be excluded. In the given price already the price is excluding GST. Again will you deduct GST? No. Ignore. An amount is to be included and in the given price it is not included. Subsidy from others to be included or to be excluded? To be included. And in the given price it is not included. So what we need to do? Add. Then next, an amount is to be excluded. In the given price it is not excluded. So we need to deduct. Example, discount. Discount is to be excluded and in the given price it is before discount. So therefore we need to deduct. So that is this. Clear? 4 treatments. An amount is to be included. In the given price it is already included. Ignore. An amount is to be excluded. It is already excluded. Ignore. If they have not done that, you do the treatment. An amount is to be included. In the given price it is not included. So you need to add. An amount is to be excluded. In the given price it is not excluded. So you need to deduct. Okay. Then there is one circular related to no claim bonus. Usually when you take a general insurance, for example vehicle insurance, etc. and all, so you are not claiming any amount for that year. Next year what is the benefit that you get? Actually it is full amount paid to the insurance company is benefit to the insurance company. Will you agree with me? You purchased a two-wheeler here. On the two-wheeler you took a insurance and you are not claiming. What happens? Huh? That entire premium is income to the insurance company? Yes or no? Now next year again you need to pay the renewal premium. In that renewal premium you get a discount. What is the name of the discount? No claim bonus. Is this no claim bonus allowed as a deduction while computing the GST payable on the insurance premium? Yes. No claim bonus is like a discount. Is it before or at the time of supply or after supply? Before or at the time of supply. For the second year premium, at the time of collecting premium itself they will give this no claim bonus na. So therefore no claim bonus is allowed as a deduction if the same is shown in invoice as per 15 subsection 3. Then next, usually when you make UPI transactions like GPay etc. and all, phone pay, GPay in some merchants, whether the full amount will be credited to the merchant or will there be any deduction? GPay no deduction. If you make payment by card, if you make payment by any other mode, they will be asking you to pay 1% extra, correct? Whereas if you are making the payment by GPay, they will encourage, okay, pay. Reason being, when you make the card payment, full amount they will not get. They will get after reducing 1%, 2% towards the processing fee. Remaining amount only they will be getting. Whereas in case of UPI transaction, full amount they will be getting. Sir, why full amount they will be getting? Because whatever processing fees which they are required to pay, that will be paid by the government. Ministry of Electronics, central government will be paying this. So therefore it will be considered as subsidy by central government and it will not be included in the value. You got it? Generally processing fees income to whom? To the intermediaries, those who do the settlement of the transactions. For them this processing fee is a income. On card transactions there will be processing fee. Even on UPI transaction also there will be processing fee, but they will not charge that processing fee to the vendor, but they will be getting this processing fee from whom? From the government. So that is like a subsidy from central government or state government, and usually subsidy from CG or SG will be included in value or not included in value? Not included in value. So with this we completed section 15. Okay. So in our previous session we completed with value of supply, and in that section 15 we have seen, and we are now required to complete this valuation rules, like rules related to valuation, which is from rule 27 to rule 35. In this rule 27 to 35, already we completed rule 33. What does rule 33 talks about? Pure agent. So what are the conditions to be satisfied in order to call the supplier as a pure agent of the recipient, so that that expenditure will not be included in the value. So here rule 27, when is it applicable? When price is not the sole consideration. One of the condition for applicability of section 15 is that price must be the sole consideration, and the other condition is that supplier and recipient are not related. Suppose if price is not sole consideration, then rule 27 is applicable. If it is related parties, supplier and recipient are related, then rule 28 is applicable. Rule 28 is not only applicable in case of related parties, but also in case of transaction between distinct persons also rule 28 will be applicable. Now, rule 29 says that whenever there is a transaction between principal and agent, then rule 29 is applicable. Sir, if there is a principal agent transaction, if there is no consideration, logically we need to apply rule 29 only. But what if there is a principal agent transaction for a consideration, then transaction value is applicable. Even then should we refer to rule 29? Yes, because section 15 subsection 5 says for notified transactions for which the value has been decided in the rules, you need to follow the rules only, even though transaction value is applicable. So therefore, what is the applicability of rules? If transaction value is not applicable, then we will be referring to the rules. Even if transaction value is applicable also, we will be referring to rules only for the transactions which are notified under the rules. Are you getting this? Example, transaction between distinct persons and principal agent transactions, we can take transaction value. Even then, as we have notified these rules for this purpose, you need to follow the rules only. Okay. In exam, they will give all the information in such a way that the transaction value we will be required to apply. But actually, the moment you see it as distinct person, the moment you see it as principal agent transaction, don't go for transaction value, come to rule 28 and rule 29 only. Then, so what does 27 says? When 27 is applicable? When price is not the sole consideration. So what we should do? First we need to take the open market value. First we need to take open market value. If the open market value is not available, money received plus money value of non-monetary consideration. If that is also not available, then we need to take like, kind and quality. If that is also not available, rule 30 says we need to take cost plus 10%. For example, I am selling you a new TV, brand new TV, in exchange of one old TV. Now in this case, price is not the sole consideration for me, because I am getting partly in the form of money and partly in the form of old TV. So which means price is not sole consideration. So I need to take the open market value. That is, as on today, what is the price at which this new TV will be sold to unrelated party, that should be taken. That is open market value. Suppose today I am not making sale of this TV to any person, then open market value not available. So then we need to take money received plus money value of non-monetary consideration. That is, how much ever money that we are receiving plus the value of old TV will be taken as the value here. Suppose if the value of old TV could not be ascertained, then in that case, like, kind and quality. What is the difference between open market value and like, kind and quality? Open market value is a comparable value on the same day, but like, kind and quality is a comparable value not on the same day when the transaction happened, on any nearest date will be taken. You can see the difference between open market value and LKQ in the next page. Comparable time will be same date in case of open market value, whereas LKQ any nearest date. And comparable value, in case of open market value, the comparable value should also be transaction value only. means between two unrelated parties, whatever is the value that has taken, that should be taken. Just like in income tax transfer pricing, comparable uncontrolled price method, CUP method is there na, so that should be taken. And whereas LKQ is not like that, either we can take transaction value or we can take value as per rules also, means some other person, the transaction is determined, like some other transaction, we determine the value as per rules. Can that also be taken as like, kind and quality? Yes, but open market value should always be the transaction value. For example, last month we made sale to a related person. For that we determined the value under rule 28. Can that value be taken as the value for today's transaction? Yes, in case of like, kind and quality. But for open market value, we should not take that, because open market value is always as on today, same date. Then next, comparable supplier. In case of open market value, same supplier or any other supplier. So between two unrelated parties, any transaction happens, that can be taken as open market value. But in case of like, kind and quality, it should be the same supplier, not any other supplier. Comparable goods, same goods in case of open market value, but in case of like, kind and quality, majorly it is the same goods. Some minor modifications may be there. For example, there is a change in the color, there is a change in slight capacity, so that can be taken as like, kind and quality. For example, a top load washing machine 6.5 kg and a top load washing machine 6.2 kg can be taken as like, kind and quality, but identical, it should be same to same. In case of open market value, there should not be any difference at all. That is called as open market value. So therefore first priority is open market value. If that is not available, money received plus money value of non-monetary consideration. If that is also not available, we need to take like, kind and quality. If that is also not available, we need to take cost plus 10%. Now this is in case of rule 27, price is not sole consideration. Suppose if it is a transaction between related parties including distinct persons. So in the second point is missing. In the second point is missing, which means open market value, then like, kind and quality, then cost plus 10%. Okay, and here we have some special points. If recipient is eligible for full ITC, we need to take open market value itself as the transaction value. For example, I am making sale to a related person, you are that related person, and you subsequently sell that to an unrelated buyer and you will pay GST. Now can you take ITC on the inward supply what you have? I am selling to you, which is your inward supply. You in turn sell it to another person. Now can you take full ITC? Yes, you can take full ITC. Why you can take full ITC? Because your outward supply is taxable. If your outward supply is exempted, can you take ITC? No. If your outward supply is partly taxable, partly exempted, can you take full ITC? No. So when you can take full ITC on your inward supply? Only when your outward supply is fully taxable, you can take full ITC on inward supply. Now in that case, any value at which I invoice to you will be taken as the open market value. So open market value is deemed to be transaction value. Reason being, if I sell it to you for 10 rupees, you in turn sell for 100 rupees, anyhow government will get GST on 100. How? I will pay GST on 10 rupees, then you will pay GST on 90 rupees, because 10 rupees you will take as credit. So you will pay GST on 90, I will pay GST on 10 rupees. So total GST to government is on 100 rupees. Suppose if I sell it to you for 25 rupees, you in turn sell it for 100 rupees. Now I will pay GST on 25, you will pay GST on 75, because you are taking this as ITC, and therefore revenue to the government will be 100. I sell to you for 90 rupees, you sell for 100 rupees. I will pay GST on 90 rupees, you will pay GST on 10 rupees, because 90 rupees whatever you paid as GST you will take as ITC. So therefore, in case of recipient eligible for full ITC, any value you declare, that is not having any problem, because subsequently he is going to pay the tax. So government will get the same revenue, there is no change in that. That's why what they are telling, open market value is nothing but the transaction value. In that case, can we report an invoice with 1 rupee? Yes, 1 rupee invoice also can be taken. That's what I have given here. In such case, the invoice can be generated for any value. Even 1 rupee can be considered as the value for this purpose. So that is here. And next we have, if recipient is not eligible for 100% ITC, then what we need to do? If recipient is eligible for 100% ITC, open market value should be taken as transaction value. If recipient is not eligible for 100% ITC, then we need to take open market value. We need to ascertain the open market value. Then, suppose if that is not available, why not available? Maybe open market value is a price between two unrelated parties on the same day, correct or not? Suppose between two unrelated parties we are unable to get the price, then we need to go for like kind and quality. If like kind and quality also not available, then cost plus 10%. Then here alternatively, that is we can ignore this completely. We can ignore this completely, and we have one more method also alternatively. What is that? 90% of the resale price. That is, I am selling to you for 10,000 rupees. Okay. And this may not be taken as the value, correct value, because you don't know this is correct value or not. Reason being, we both are related parties. I am selling to you for 10,000. How 10,000 can be taken as the value? We cannot, because between related parties, definitely the value may be tampered, correct or not. That's the reason why you need to see what is the price at which subsequently you are selling. Say you are actually selling at 15,000 rupees. In that 15,000, your resale price, okay, I am selling to you, you subsequently sell for 15,000. In that 15,000, 90%, what is 15,000 into 90%? 13,500 is my value, got it? 15,000 into 10% is 1,500. So 15,000 minus 1,500, 13,500. So 13,500 will be taken as my value. Means what is the logic here? Your value addition will be 10%. So that's why what they are telling, alternatively in case of goods, but this discussion is only in case of goods, not in case of services. So at the option of the supplier for each supply, 90% of the price at which recipient supplies like kind and quality to unrelated buyer. Recipient should not process those goods but should have been sold as such. So I am selling to you, you are my related person, you subsequently sell to unrelated buyer. On that price we will take 90%, and you should not be processing and selling it, you should be selling it as such. And that too, this alternative is applicable only in case of goods, and this alternative can be chosen by supplier. Means I can decide, either I can go for open market value, like kind and quality, cost plus 10%. Alternatively, I can do 90% of the resale price also. So I can decide with respect to each transaction, with respect to each supply I can decide. Then next, number 3, principal agent transaction. Then the value will be determined as per rule 29. And principal agent transaction is applicable only in case of goods. Why only in case of goods but not in case of services? Because principal agent transaction 71C is applicable only in case of goods, not in case of services. That's the reason why principal agent transaction only with respect to goods. So for the third point is missing. So for the third point is missing. What is that? Like kind and quality is missing. Only open market value, if not cost plus 10%. So open market value or cost plus 10%. Open market value has the alternative which we discussed before. What is that? 90% of the resale price. So therefore, at the option of the supplier, when the transaction is between principal and the agent, either they can go for open market value or they can take 90% of the resale price at the option of the supplier for each supply. If that is not available, then they can go for cost plus 10%. Suppose if cost is also not available, what should be taken as the cost? If I am a manufacturer, I will take cost of production plus 10%. If I am a trader, I will take cost of acquisition, that is cost of purchase plus 10%. If I am a service provider, I will take cost of providing service plus 10%. Suppose if this cost is not ascertainable, what should I do? Then we have rule 31, which says that we need to go for residual value, where the value will be determined by the GST officer. So based on the principles of valuation, the value will be determined, that is as per rule 31, which is residual value. So for rule 30, what should be taken as the cost? Cost of production in case of manufacturer, cost of acquisition in case of trader, and cost of providing service in case of service provider. Then in case of services, basically cost cannot be determined. For manufacturer, we have cost of production. For trader, we have cost of acquisition, easily that can be determined. But cost of providing service is difficult to determine because there is no standard rate available for the cost of providing the services. Okay, you take any services, there is no standard rate. So even for 200 rupees also GST return is being filed. For 2000 rupees also GST return is filed. For 20,000 rupees also GST return is filed. For your information, I am telling you. So because lot of people, GST return is something they need to take the data and put it in the return and file it. So total all amounts they will put it as B2C and they will file the return for 200 rupees. Yes. So if you want, you come to Chennai, I can show you what a lot of people wherein 200 rupees, even 100 rupees, 99 rupees only, like that also return will be filed. Okay. So therefore, there is no standardization. Audit, sir, that auditor is doing audit for 4 lakhs, I will do it for 2 lakhs, sir, you give, sir. Yet another idiot will come and say, I will do for 1 lakh rupees, sir. So where there is standardization with respect to services, that's the reason why cost of providing service, we can skip rule 30 and we can directly go to rule 31. So this is about rule 27, 28, 29, 30 and 31. And this is the GST implications on debit note and credit note, which I have been discussing in the previous, that is section 34 talks about debit note and credit note. So when debit note and credit note will be given, so whenever there is a increase in invoice value, what is the name of the note? Debit note. Whenever there is a decrease in the invoice value, what is the name of the note? Credit note. Generally, who will give debit note and credit note to whom? In GST, only supplier will give it to recipient, and recipient will not be giving it to supplier. And therefore, when recipient is required to pay an amount beyond the invoice value, then we will give debit note. When recipient has to pay an amount less than the invoice value, we will be giving a credit note. Is there any time limit available for debit note? No time limit for debit note, because debit note leads to what? Increase in revenue to the government. How? Increase in tax. Increase in tax means their revenue will increase. That's why no time limit. Even after 50 years, 100 years also, you can give debit note for a transaction which happened. But credit note leads to reduction in liability, means loss of revenue to government. So time limit is there. What is that time limit? 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. So there are a few places where the time limit is this only. So that is time limit for availment of ITC, input tax credit. Then time limit for issuance of credit note. Time limit for rectification of GSTR 1. Time limit for rectification of GSTR 3B. And time limit for rectification of GSTR 8. GSTR 8 is a return which will be filed by e-commerce operator, TCS deductor. These 5 places, the time limit is common. What is that? 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. So what are the 5 things? So time limit for availment of ITC, time limit for issuance of credit note, time limit for rectification of GSTR 1, time limit for rectification of GSTR 3B, time limit for rectification of GSTR 8. These 5 places, the time limit is common. What is the time limit? 30th November of succeeding financial year or date of filing annual return, whichever is earlier. Now, because of debit note, what will happen to the supplier? What will happen to the supplier's tax implications? The supplier's liability will increase because you need to pay the additional tax on that. Because of this, what will happen to the recipient? Recipient can take ITC. Can recipient take ITC based on debit note? Yes. Debit note is one of the valid document for the purpose of availment of ITC. Supplier need not give invoice. If the debit note is given, even on the basis of debit note also, recipient can take ITC. And whether this debit note should be reported in GSTR 1 and GSTR 3B? Of course, yes. So debit note should be reported in GSTR 1 and even that liability should be paid in GSTR 3B, reported in GSTR 1 and 3B. And what will happen because of this? Recipient ITC will increase. So whenever ITC we are talking about, only in one return we will make the change to that. That is GSTR 3B. So in which return the recipient will avail ITC? Only in GSTR 3B. Then credit note will be given by a supplier to recipient. What is the consequence of credit note to the supplier? There is an increase in liability or decrease in liability? Decrease in liability. Should it be reported in the returns? Yes. In GSTR 1 and GSTR 3B it should be shown. And because of which, what will happen to the recipient? Recipient's ITC will be reduced. Suppose if the recipient is not having that much balance of ITC, what will happen? It will be added to their liability. So either reversal in ITC, if they have balance in ITC, if they don't have balance in ITC, increase in output tax liability. and where they need to report this information? They need to report this information in GSTR 3B. Then we have rule 32. So we have completed so far up to rule 31 na. So one more rule is also there, that is rule 31A, and then we will come back to rule 32. Rule 31A you can see in the next page below. So what are the three actionable claims which are covered under supply? Lottery, betting and gambling. So for lottery, betting and gambling, how to determine the value? That is given in rule 31A. So what does it say? If it is a lottery ticket, you see what is the face value of the lottery ticket or the price notified by the organizing state. Take whichever is higher. Why the price notified by the organizing state will change? Say for example, they printed lottery tickets, but that many tickets are not being sold because people in Kerala are having lot of issues. So every year some issue or other will be coming. So they don't have money to buy the lottery ticket also. Now what state will do? They will say, okay, 500 rupees lottery ticket, we are notifying the price as 400 rupees because they cannot reprint the lottery tickets again because that is an unnecessary cost. And the fate of Kerala government is so pathetic that they are giving police station and polices and all for rental basis in order to generate the income to pay the salaries to the police people. I don't know what happened to Kerala all of a sudden, and financial situation is so pathetic, and therefore again reprinting the lottery tickets and all will be a costly affair for them. That's why what they will do, they will give one official gazette and they will be specifying the price of the lottery ticket has been reduced from 500 to 400. Now what should be taken for computing GST? So GST will not be computed on 400. Here central government is smart. What they will do, whichever is higher you pay. You understood or not? 28%. The rate of GST is 28%. And why will government will be losing its revenue? Kerala government, you lose revenue. Why we should lose the revenue? So therefore 28% will be taken as GST. So therefore how this 28% will be computed? On inclusive basis. So therefore price of the ticket is 500 face value, notified by the organizing state 400, whichever is higher will be 500. 500 into 28 divided by 128, that will be taken as the GST payable. Suppose if people of Kerala are so happy that lot of wealth they are having, so lot of money they are having. Now in this case, because all the people who went to Middle East came back to Kerala, so then automatically Kerala will become the richest state, okay, and this people and all 500 will pay 1000, no issue, take. So like that, people are ready to pay more amount also, but already ticket is printed. Now Kerala government release in official gazette as there is a huge demand for this lottery ticket. So due to that reason, we are increasing the price from 500 to 750. Now what will be taken as the price for computing GST? 750, whichever is higher, you understood. So 750 into 28 divided by 128 is taken as the GST, and remaining 100 divided by 128. 28 by 128 is GST component. Then 100 divided by 128 will be what? Value. Then in case of lottery, betting and gambling, including horse racing, so what should be taken as the value for payment of GST? So generally in case of horse racing or winning from gamblings or bettings, etc., GST is not payable by the person who won the amount, but GST is payable by the totalizer, that is who is organizing the betting transactions. Say for example, there is a there is a betting, some Dream 11, etc., like that betting transactions are happening in the Dream 11. So Dream 11 is the organizer, totalizer. Now what they will do, they will collect money from all the people, but they are not going to pay money to all the people. Those who won the bet, for them only they will be paying, correct or not? So therefore, whether you are winning or losing, government will be always winning, which means whatever is the total amount that is collected by the totalizer, on that GST will be payable at the rate of 28%. So 100% of the face value of the bet or the amount paid to the totalizer, not on the commission earned by the totalizer. Say for example, 100 people are participating in the bet. Each person paid 2000 rupees. So what is the total bet value? 200 into 100. So that will be 22 lakhs. So 2 lakhs will be taken as the total bet value. On the 2 lakhs into 28 divided by 128, will be taken as the GST payable. You understood or not? But entire 2 lakhs will not go into the pocket of the totalizer. What will happen? Out of the 2 lakhs, he need to pay the gift money, prize money to the people. Plus he will get his commission. On entire amount, there will be 28 by 128. Okay, sir. Now I won the bet. I got some 20,000 rupees. On that, should I pay any GST? No. Why? Because on the total amount, already totalizer has paid. I don't have to pay anything. I need to pay only income tax. But that also they will deduct 30% TDS and they will be giving it to us. So due to that reason, so that anyhow income tax is already deducted at source itself. You understood or not? So, but GST is not payable by the person who won the bet amount, because totalizer will pay GST on the total bet value. That is about this rule 31A. Now we are moving on to rule 32. Rule 32 is value of supply in special situations. That is, they have given 5 situations. In these 5 cases, either we can go for transaction value or we can determine the value as per rule 32. So they have given a simplified valuation methodology. Either follow transaction value and pay GST. If is transaction value difficult for you, don't worry. You can follow this rule 32 value also. So whichever is convenient to you, can follow with respect to each invoice. Either transaction value or value under this rule at the option of supplier for each supply. Now, what are the 5 cases for which this rule 32 will be applicable? Foreign exchange transactions including money changing, that is conversion from one currency to another currency. So that is foreign exchange transaction including money changing. Then second case, air travel agent services. Air travel agent who do the booking of air tickets will be coming under this case. So first one, foreign exchange transaction including money changing, and second will be air travel agent, and third will be life insurance business, not life insurance agent, life insurance business. And thereafter, a person who is engaged in dealing in second-hand goods. So he is buying and selling second-hand goods. So therefore, he is a second-hand dealer in goods. He is buying second-hand goods and he is selling second-hand goods. Then next one, in case of coupons or vouchers. And then this notified service between distinct persons, at present it is not applicable because services are yet to be notified. So you don't have to remember this. Only 5 cases you need to remember: foreign exchange transactions including money changing, air travel agent, life insurance business, second-hand dealer in goods, vouchers, coupons, etc. Now let's start with the first one, foreign exchange transaction including money changing. So here they have 2 options again. Already rule 32 itself is an option. In that rule 32 again we have 2 options. So option 1, rule 32 2A, what does it say? Check whether one of the currency exchange involves Indian rupee and RBI reference rate is available for that currency on that day. Then you take bid rate or ask rate minus RBI reference rate into units of currency. For example, we have a quote rupee per dollar, that is 85 and 89. So 85 is actually bid, bank dollar buying rate. 89 is asked, bank dollar selling rate. Now exporter sold $10,000. Exporter sold $10,000. Then what bank is doing? Bank purchases dollars. Bank purchases $10,000. So relevant rate is what? Bid rate or ask rate? Relevant rate is bid rate. That is rupees 85 rupees per dollar will be taken as the relevant rate here. Then RBI reference rate for this transaction. RBI reference rate, from time to time RBI will be giving reference rate. Right now RBI is not giving reference rate. They have outsourced this work to FBIL, Financial Benchmarks India Limited, and they will be giving the reference rate. So but still in the law they uses the word RBI reference rate only. Say the RBI reference rate for this transaction on this date is say 83 rupees per dollar. Now in this case, what should be taken as the value? Value equals to, so transaction rate. What is the transaction rate? 85. And what is the RBI reference rate? 83. Into what is the units of currency? 10,000 units, because it is $10,000. So therefore that will be equals to 2 into 10,000, that is 20,000 rupees will be taken as the value. This is as per rule 32 sub rule 2A. Now option 1. This is actually option 1. This is actually option 1. Okay. One of the currency exchange involves Indian rupee and RBI reference rate is available for that currency. Then purchased currency or sold currency minus RBI reference rate into units of currency will be taken as the value. Whereas option 2 is also there. What is that option 2? Option 2 here is a slab rate model. Suppose if the gross amount is up to 1 lakh, if the gross amount involved in the transaction is up to rupees 1 lakh, then 1% of the gross amount or 250, whichever is higher. For example, if the gross amount is 80,000, 80,000 into 1% will be 800. 800 or 250, whichever is higher, will be 800. Suppose if the gross amount is 20,000, it is in the first slab. 20,000 into 1% will be 200. 200 or 250, whichever is higher, will be 250. Suppose if the gross amount is exactly 1 lakh, 1 lakh into 1% will be 1000. So 1000 or 250, whichever is higher, will be 1000. So the moment when you go into the second slab, what is the minimum amount? 1000. So second slab will be applicable when the gross amount exceeds 1 lakh but does not exceed 10 lakhs. Suppose if the amount is 3 lakhs. So 3 lakhs, it comes in the second slab. For first 1 lakh, how much? 1000. Then remaining 2 lakhs, what is the percentage we need to multiply? 0.5%. So 2 lakhs into 0.5%, 1000 rupees. So 1000 plus 1000, 2000 will be taken. Suppose if it is 8 lakhs, for 1 lakh it will be 1000. So remaining how much it is? 7 lakhs. 7 lakhs into 0.5%, 3500 plus 1000, 4500. Exactly 10 lakhs, means we are at the end of this slab. So 10 lakhs. 10 lakhs, for first 1 lakh it will be 1000. Remaining 9 lakhs. 9 lakhs into 0.5%, 4500. 4500 plus 1000 will be 5500. So we are into the third slab. So in the third slab, what is the basic amount? 5500 plus an amount exceeding 10 lakhs into how much percentage we need to multiply? 0.1%. Remember, first slab 1%, second slab 0.5%, then third slab will be 0.1%. And 0.1% of the amount exceeding 10 lakhs, subject to maximum. This total should be maximum how much? 60,000 rupees. If it crosses 60,000 rupees, 60,000 only will be taken as a value. For example, if it is 80 lakhs, for first 10 lakhs it will be 5500. Remaining 70 lakhs. 70 lakhs into 0.1%. How much it comes to? 7,000. 7,000 plus 5,500 will be 12,500. So that much, 12 or 11,500. 12,500. So 12,500 will be taken as the value. Suppose if it is say 500 lakhs. 500 lakhs. First 10 lakhs it will be 5,500. Next to 490 lakhs. 490 lakhs into 0.1% is 49,000. 49,000 plus 5,500. So that is 54,500. Still it did not cross 60,000. So but maximum amount is 60,000 rupees, and this should be done per transaction. You understood? This should be done per transaction. In this case, so same example, what should be taken as option 2? What should be taken as option 2 value? So first you need to see the gross amount. What is the gross amount in Indian rupees? How many dollars is it getting exchanged? $10,000. What is the price of each and every dollar here? Exchange rate 85. 85 rupees per dollar. So 10,000 into 85 will be 8,50,000. 8,50,000 means that comes in the second slab. So what will be taken as the value? For first 1 lakh it will be 1000 plus what is the excess amount? 7,50,000. On that 7,50,000 we need to take 0.5%. So that will be coming to 3,750 plus 1000, that is 4,750 will be taken as the value. Sir, here option 2 itself is better because the value is 4,750, but under option 1 the value is 20,000. Then we will go for option 2 itself. You cannot decide like that because this option, one selected in the beginning of the financial year, will be applicable throughout the financial year. You can see that part. Option to be decided in the beginning of the financial year, which shall be applicable throughout the financial year, which means between this option 1 and option 2, not between transaction value and rule 32. Between transaction value and rule 32, for each supply you can decide. Between transaction value and the rule 32, you can decide between each invoice. But the moment you enter into rule 32, in that rule 32 for forex transaction, again you have option 1, option 2. In these two options, you need to decide any one thing in the beginning of the financial year, and that will be applicable throughout the financial year. Now, in this option 1, so one of the currency exchange involves Indian rupee and RBI reference rate available for that currency on that day. What if RBI reference rate is not available? If RBI reference rate is not available, so that is in the same question, what if RBI reference rate is not available? If the RBI reference rate is not available, then we have another method of valuation. RBI reference rate not available. If RBI reference rate is not available, then you take the gross amount exchange involves Indian rupee and multiply with 1%. So what will be taken as option 1 value? Gross amount Indian rupees. So $10,000 exchange at what rate? 85 rupees per dollar and multiply with 1%. So 10,000 into 85 into 1%, that will be 8,500 will be taken as the value. And option 2, will it change? No. Option 2 will not change. Why option 2 will not change? Because 4,750, the slab rate model will remain the same, because the slab rate model is based on gross amount. So only option 1 will change if RBI reference rate is not available. So if RBI reference rate is available, purchased currency or sold currency minus RBI reference rate into units of currency. If RBI reference rate not available, gross amount exchanged Indian rupees into 1%. Then suppose we have third situation. If both the currencies exchange involves foreign currencies, both the currencies are foreign currencies, then in that case convert both the currencies into Indian rupees using RBI reference rate and multiply with 1%. Take whichever is lower, not whichever is higher, it is whichever is lower. Generally in exam we get confused between whichever is higher and whichever is lower. So that alone you please highlight and separately you write and keep, so that you will not get confused. So one day before the exam, when you are going to the exam, you can quickly revise that. So which and all places, whichever is higher, whichever is lower, because usually in exam we will get confused with respect to this, because in valuation itself, in one place, that is lottery tickets, we have seen price notified by the organizing state or the face value of the ticket, whichever is higher we have taken. But in this place we are taking whichever is lower. That is when both the currencies exchange involves foreign currencies, convert both into Indian rupees using RBI reference rate into 1%, whichever is lower. That's why. So now what is this scenario? It is simple. We have rupee per dollar or rupee per pound, like that. We don't have any exchange rate. We have an exchange rate which is denominated in foreign currency. So dollar per pound. Okay. So 1 pound will be $1.8 and $2.2. Okay. 1 pound will be $1.8 and $2.2. 1.8 is the bid and 2.2 is ask. Now what happens here is that a person, exporter exchanges 6,000 pounds for dollars. So which means what bank is doing? Bank is buying pounds. Bank purchases pounds. Bank purchases pounds means what is the relevant rate? Relevant rate will be $1.8 per pound. Bid will be the relevant rate. And so therefore we have got $6,000 converted into how many dollars? 6,000 pounds converted into how many dollars? So 6,000 pounds is converted into how many dollars? Multiply with 1.8. 6,000 into 1.8. $10,800. Now convert this both into Indian rupees using RBI reference rate, because where this transaction is happening? In India. So convert both into Indian rupees. What is the exchange rate? Rupee per dollar, RBI reference rate. Assuming that rupees 108 per pound, and this is RBI reference rate for pound, and for dollar say it is 82 rupees per pound. So now, per dollar. So convert both into Indian rupees using RBI reference rate, multiply with 1%. So now we need to take whichever is lower. Whichever is lower. So what is the final answer that we will be getting? 6,000 into 108 into 1%, 10,000 into 82 into 1, 10,800 into 82 into 1%. Whichever is lower, that should be taken as the value. That is 6,480. 6,480 will be taken as the final value, whichever is lower. So compare both and take whichever is lower. So 6,480 will be taken as a value in this case. So this is how we need to determine when both the currencies exchange involves Indian rupees and RBI reference rate is available. So both the currencies should be converted into Indian rupees. But this is the catch here. What if RBI reference rate is not available? Then can you do this calculation? No, you cannot do this calculation. Then what you should do? Then you need to go for regular transaction value itself. So transaction value will be taken as the currency conversion fee or the currency markup fee. Whenever foreign exchange is converted into Indian rupees, banks or financial institutions will be charging a currency conversion fee or a currency markup fee. So that currency conversion fee or markup fee will be taken as the real transaction value for payment of GST. So when both the currencies are foreign currencies, you need to convert into Indian rupees using RBI reference rate. What if RBI reference rate not available? Then you cannot determine the value here. So you need to go for regular transaction value only for the transaction. Then option 2 is a slab rate model, already we discussed. Then rule 32 sub rule 3 is for air travel agent. For air travel agent, we need to check whether that bookings what he has made is domestic bookings or international bookings, whether he is booking a domestic ticket or an international ticket. If he is making a domestic booking, 5% of base fare in case of domestic bookings and 10% of base fare in case of international bookings will be taken as a value. What is the base fare? In every ticket there will be base fare, fuel surcharge and other charges and taxes. So this base fare is the basic fare which every person has to pay, and it will go to the airlines, whereas fuel surcharge will go to the government, and then other charges and taxes are for their value added services including the GST on transportation. So this base fare is the first component. On that 5% will be given as commission to the air travel agent in case of domestic bookings, 10% in case of international bookings. Even though their actual commission is more or less than this, but they need to take this one only as the value, because air travel agent will get lots of commissions. So all those commissions will be taken as their transaction value. So what should be taken as transaction value in case of air travel agent? Commission on transaction value. Suppose if they don't want to follow this transaction value, they can go for this. What is the rule 32 value for them? 5% of base fare in case of domestic bookings and 10% of base fare in case of international bookings. Then life insurance business. In case of life insurance business, we have different types of policies. The entire set of policies are divided into risk cover policies, single premium annuity policy, reinvestment policy and other policy. Risk cover policy means like term insurance, wherein we will pay some amount and there is a sum assured. The premium payable will not commensurate with the sum assured, and in the event of death etc., the sum assured will be paid to that person. For example, you are taking 2 crores term insurance, but the premium what you pay will be hardly like 1 lakh per annum, and you will pay it for some 10 years or 20 years only. So 20 years into 1 lakh is what? 2 lakhs only you are paying. But in this 20 or 25 years, anything happens to you, 2 crore rupees you will be receiving from the insurance company. If nothing happens, whatever premium you paid is income to the insurance company. This is known as risk cover policies or term insurance. So in risk cover policies, what should be taken as the value? Entire premium will be taken as the value. Whereas single premium annuity policy, in single premium annuity policy, rather than paying every year a premium, one single premium will be paid. Using that single premium itself, so the insurance company will reinvest and will be able to generate the income that will be adjusted towards the premium. For example, every year you have to pay a premium of 1 lakh, but you will not give every year 1 lakh. Instead, you will be giving the insurance company 10 lakh rupees. Using the 10 lakh rupees, every year they will invest and they will generate a return of 1 lakh, and that will be taken towards the premium. So like that they will do. So this is known as single premium annuity policy. In single premium annuity policy, not entire premium will be taken as income to the insurance company. So we need to take 10% of the single premium. So for risk cover policies, what should be taken as a value? Entire premium. For single premium annuity policy, what should be taken? 10% of the single premium. Then reinvestment policy. Reinvestment policy means like ULIP, unit linked insurance plan. Whenever you pay money to the insurance company, premium to the insurance company will be reinvesting that in the equity market and will be giving you units. So whenever the equity market value increases, the NAV of the units also will increase. So at the time of maturity or death, whichever is earlier, whatever is the NAV of the units, so that much will be paid to you. So that is known as reinvestment policies. In reinvestment policy, how much money will go into the pocket of the insurance company? premium collected minus amount allocated for investment. So which means that difference only will be taken as the money in their hand. So gross amount collected minus amount allocated for investment. But there is a condition that if amount allocated for investment is not communicated to policyholders, then it is treated as other policies. So when reinvestment policy, we should communicate, sir, whatever premium you give, 90% we are investing in equity market, 30% we are investing in the debt market, like that. Some ratio needs to be communicated to them. So only then, it will be called as reinvestment policy. Otherwise, it will be other policies. For other policies, what should be taken as the value? 25% of the premium in first year and 12.5% of the premium in the subsequent year. What is the meaning of first year premium and subsequent year premium? Every year insurance company will be having first year premium and subsequent year premium. So this is the first year in which they started their business. So which means this is the first year premium. And so second year also there will be first year premium. How? Second year, when they have already started business in the first year, for the second year they will issue new policies to some people. So that will be first year premium. Whatever premiums which are payable by the person who took the policy in the last year will be called as subsequent year premium. Means insurance company, for every year they will be having first year premium and subsequent year premium. First year premium means this year whatever policies they have given and premium collected, that is first year premium. Last year whatever policies they gave, for which the premiums collected this year will be known as subsequent year premium. So on first year premium, what should be taken as the percentage? 25%. On subsequent year premium, how much should be taken? Half, that is 12.5%. So 4 points you need to remember here. That is, in case of risk cover policy, entire premium collected will be taken as income to the insurance company. In case of single premium annuity policy, total premium into 10%. In case of reinvestment policy, premium collected minus amount allocated for investment. And in case of other policies, 25% of the first year premium and 12.5% of the subsequent year premium. Then next, rule 32 sub rule 5, buying and selling of second hand goods. That is, there is a person who is engaged in second hand goods. So what should be taken as the value generally? For example, I am a second hand car dealer. I purchase a car for 1 lakh and I sell the car for 1,50,000. Now what should be taken as value for payment of GST by me? And definitely I will cross the threshold limit and I need to register and I need to pay GST. So I need to take 1,50,000 and pay the GST. GST on the car will be 28%. So 28% I need to pay GST. Because of this, definitely the buyer will have a burden of tax, because on the car already GST has been paid originally. At the time of new car purchase, already GST paid. So when I am buying the second hand car, again I should pay GST. So that is definitely a huge burden on the buyer. To avoid that only, they have brought in this margin scheme. What does margin scheme says? See what is the price at which he is selling. What is the price at which I am selling here? 1,50,000. What is the price at which I am buying the car? 1 lakh. What is the difference? 50,000. On that 50,000 only I will pay GST. Instead of paying GST on entire 1,50,000, I will pay GST only on 50. What is the advantage of this to the buyer? Instead of charging him 1,50,000 into 28%, I am charging him only 50,000 into 28%. So buyer will be happy. But there is one problem in this place. That is, buyer will know what is my margin. So because I am charging him 28% on 50,000, so buyer will know easily whatever is the margin that I am making, 50,000. So it's okay, because nothing wrong in conveying our margin to the buyer, because we need to do some value addition to the vehicle now. That fact he will not know, because whatever the mode in which we purchase the car, the same way we will not sell it to him. So we will remove the dent, we will make the body paint, we will replace the parts, many things we will be doing. So therefore nothing wrong in conveying. Ultimately, if the buyer is getting a lesser tax burden, he will be very happy about that. Are you understanding this? So this is about margin scheme. What is the value addition is negative? When it will be negative, in mobile market it will happen. That is, I purchase iPhone 14 Pro Max in second hand from a person for 80,000 rupees, and then I have kept it for sale for 95,000 rupees, and people are not buying. Suddenly, Apple has released the iPhone 15 Pro Max, nothing, same thing. So, but little bit changes they have done. So, but people don't know, no? Because basically Apple users are idiots, including me. So they don't know anything about that. And just for the sake of status, so they will be purchasing it. And yes, status only, because if I am using Android mobile, no, people around me think that I am one poor fellow, okay. No one will be respecting me here. What to do? So that's why I'm forced to use Apple phone even though I don't like it, okay. And therefore what happens here is that 14 Pro Max to 15 Pro Max, nothing, same, okay, same thing, just a name changed, okay. And USB-C, which was actually some 10 years before USB-C which came, now only Apple has given that, okay. And for this, so as new mobile come, what will happen to the old mobile value? Automatically it will come down. So therefore no one is ready to buy for 95,000, but people are ready to buy for 75,000. At what price I purchased? 80,000. I am forced to sell at 75,000. So there is a negative value addition. Should I pay any GST on that? No. That is a major advantage in case of margin scheme. So see this, value equals to selling price minus purchase price, that is margin scheme. No value if the margin is negative. And one important condition is that at the time of purchase of the second hand goods, I should not avail the ITC, because if I avail the ITC, already I am enjoying that benefit. Again I am getting margin scheme also, so they will not give both. So if I am availing ITC, I should pay GST on the full sale value, not on the margin. So ITC should not be availed on purchase. Then the same margin scheme is even applicable in case of repossessed goods which are sold by the financier. Usually financier will give finance with respect to various goods including the vehicles and all. Say one person is planning to buy a lorry, and for purchase of that lorry they have taken finance. Now the financier will wait for installments. Suppose if the person is not paying the installments, what the financier will do? He will repossess that lorry and he will sell it off, because he need to recover his finance amount now. So therefore whenever he repossesses the lorry and he sells it, he is also as good as second hand dealer in goods, because he is not buying a new lorry and selling it. So at the time when he repossesses it, it will be a second hand lorry only, and when he sells it, he will come under second hand dealer in goods. Is he also eligible for margin scheme? Yes, he is also eligible for margin scheme. But what should be taken as the sale price, whatever price at which he is selling? What is margin scheme? Come on, respond. Sale price minus purchase price. Sale price is the price at which he will be selling. What will be taken as a purchase price? He did not buy because he repossesses it. So what should be taken? Original purchase price minus depreciation. How much is the depreciation? 5% for every quarter or part thereof from the date of purchase till the date of sale of repossessed goods. So 5% for every quarter or part thereof from the date of purchase till the date of disposal of that repossessed asset. So they need to compute that 5%, and from original purchase price that should be reduced. Then in case of vouchers or coupons, what should be taken as the value? Why we need to determine the value in this case? Not every voucher or coupon will be having monetary amount mentioned on the voucher. Sometimes the vouchers will not have any monetary amount mentioned, but a product or service will be mentioned, which is called as an identifiable voucher. When you go to Domino's and you eat for 500 rupees, they give you one voucher. That is, next time when you are visiting Domino's, you will get one regular veg pizza free from Domino's. So now in this case, this voucher value is what? What is the value of this voucher? Simple. If you redeem that voucher, what you will be getting? One regular veg pizza you will get. What is the price of that regular veg pizza? 199 rupees. So therefore 199 rupees will be taken as a value of this voucher. Okay. So value of the voucher, money value of supplies redeemable against such voucher. Why we need to determine this value now? Because generally we need to pay GST at the time of issuance of voucher only in case of identifiable voucher. The time of supply in case of identifiable voucher is at the time of issuance of voucher. Today I am giving the voucher, whether you redeem it or you throw it, but I have to pay GST on that if it is an identifiable voucher. So therefore, when I need to pay GST, I need to know the value of that now for payment of GST. So therefore, this 199 rupees into whatever is the applicable GST on pizza, so that will be taken for payment of GST. That is with respect to this. Then notified services between distinct persons will be taken as nil, but right now it is not applicable because they have not notified any services for this purpose. So these are the 5 cases where we need to take the value as per rule 32. Alternatively, we can follow the transaction value also. Okay. Suppose in the question, if they have given transaction value also and they are also asking you to determine the value as per rule 32, you do it under both and you select which is the lower value that should be selected. Okay. Whereas RBI reference rate point, that foreign exchange transaction, If they give both the options, do both the options, but don't select there anything. Reason being, you have to select it in the beginning of the financial year. Now, look into one circular related to tax collected at source under Income Tax Act. That is, whenever you buy a car, I am a car dealer, I am selling the car to you, not a second-hand car dealer, first-hand car dealer only. You wanted to buy a car from me. Now, I will be collecting TCS from you. So, tax collected at source from you I will be collecting. What is this TCS? Why I will collect this TCS? Because Income Tax Act mandates me to collect TCS from that person. So, at the rate of 1%, so that Income Tax Department wanted to understand what is the source of income of the person who is buying that car. Actually, this 1% is not the income tax which you need to pay. This 1% is a tax on your expenditure. You are spending by buying a car. So, when you buy a car, so TCS 1% is being collected by me and I will remit it against your permanent account number. Actually, it is not your income tax. Are you getting this? So, now government income tax department wanted to understand what is the source of income of yours. So that's the reason why this TCS is being collected. So this TCS is not having the character of income tax, but it is an interim levy just to identify the source of income of that person. So this should not be taken as income tax. This is as per CBDT circular. Okay. Now the question here involved is that as per 15 subsection 2 clause A, any taxes, duties and cess by whatever name called should be included in the value other than GST. Is TCS under income tax other than GST? Yes. Then logically TCS under income tax should be included in the value. But CBSE circular says that TCS is not a tax, it is an interim levy, not having a character of tax. So don't include it while computing the GST. Under section 15 subsection 2 of CGST Act, any taxes, duties shall be included in the value of supply, but TCS is not includable in the value. Why? Because as it is an interim levy but not having character of tax, that's why no need to include it. That is as per CBSE circular. Then one more circular that is related to banking companies. Usually banking companies will be appointing business facilitators and business correspondents. What these business facilitators and correspondents will do? They will do the functions of the bank in many places. So on behalf of bank they will be acting, for which they will be paid a commission. Now say for example a banking company appoints a business correspondent or a business facilitator in one location and they will be providing the services to the customer on behalf of the bank. Now they will collect the service charges from the customer and they will remit the service charges to the bank. On the service charges, who will pay GST? Bank only should pay GST. Because these people are just acting as intermediary in collecting the service charges. But these intermediaries will get a commission. On that commission, they need to pay GST. You understood? So, on the service charges which are collected by business facilitator or correspondent, who will pay GST? Bank will pay GST. Then, what is the value on which they pay GST? Business facilitator or correspondent? They get a commission. So, on that commission only they will pay GST. And then, Rule 34, what is taken as the Rule 33 already we have completed. 27, price is not sole consideration. 28, related party transaction including transaction between distinct persons. 29, principal agent transaction. 30, cost plus 10%. 31, residual value. 32, that 5 special transactions, what should be taken as the value. Then 33, pure agent. 34, we are discussing what should be taken as the relevant exchange rate. Generally, whenever the transaction is denominated in foreign currency, you need to convert that into Indian rupees. Why you need to convert into Indian rupees? Because GST is payable in Indian rupees. For example, I am importing services. When I import the services, I need to pay GST under RCM on import of services. So, I need to convert that invoice into Indian rupees. For converting it into Indian rupees, I need to take a exchange rate. What exchange rate should be taken? If it is goods, I need to take CBIC notified exchange rate. If it is services, I need to take GAAP rate. What is GAAP rate? Generally accepted accounting principles. Average of the buying rate and selling rate for the day should be taken. That is GAAP rate. As per accounting standards and Ind AS, generally whenever the transaction is happening in foreign currency, we need to recognize that transaction using the average of the buying rate and selling rate. So therefore, that is the GAAP rate. So for goods, which rate to be taken? CBIC notified rate. For services, we need to take GAAP rate. Prevailing on which date? Prevailing on the time of supply determined under section 12 and 13 of CGST Act. So first, for a transaction, we need to determine the time of supply. On that time of supply, whatever is the CBIC notified rate for goods and GAAP rate for services should be taken and converted into Indian rupees, and you pay the GST. Now, the actual amount may be different. For example, I took a transaction at $1 equals to 83 rupees and I paid the GST. But actually it is 85 rupees per dollar. Now, on that extra 2 rupees, should I again pay any GST? No need. Ignore the exchange gain or loss. Exchange gain or loss shall be ignored for the purpose of GST. So with this, we completed fully value of supply.